Welcome to the Physician's Guide to Financial Wellness, the podcast dedicated to helping physicians in Michigan turn their professional success into financial success while enjoying life along the way. And now, here are your hosts, Andrew Mushbaugh and Trent DeBruin.
Hi, everyone, and welcome to another episode of the Physician's Guide to Financial Wellness. This is Andrew Mushbaugh, and I'm joined, as always, by my co-host, Trent DeBruin. And today we're going to talk about the biggest determinant of having a successful long-term investment outcome, which is managing the emotions of investing. And when it comes to the emotions of investing, the biggest disconnect often comes down to conceptually knowing what you should do versus actually doing what you should do. Or said differently, it's the difference between knowing you should eat healthy and exercise to lose weight versus actually eating healthy and exercising. It's easy to conceptually understand, but hard to implement. Who wouldn't want to take a shortcut, like drinking apple cider vinegar or wearing an ab belt versus doing the hard work?
Yeah, what about the juice cleanse? Isn't that the silver bullet?
Oh yeah, that's the one shortcut.
Yeah, exactly. And with no downside. It's basically the investment equivalent of Dogecoin or any other get-rich-quick type of investment.
Yeah, that's actually a great comparison. And so for those who believe in juice cleanses or Dogecoin as the silver bullet, then this may be a good point to stop listening. But for those who realize there isn't a shortcut with investing, you may want to keep listening. And before I give an overview of what we'll cover today, I read this quote the other day that is very applicable to what we're going to discuss. The quote was, "People very often do not accept the truth because they do not like the form in which the truth is presented to them." While this wasn't meant to be related to investing, it's easy to see how relevant it is to the emotions of investing. What would you be more interested in learning about? Number one, if you follow XYZ expert, you'll be able to quote-unquote beat the market. Or number two, here are the realities of investing. Of course, learning more about the shortcut to beating the market is more appealing, but that doesn't make it true. And it probably won't surprise anyone listening that we're going to focus on the realities of investing, which is where emotions come into play and why it's so important to be able to manage them. But what we'll discuss today is how to better manage the emotions of investing, which we'll break down into three topics. Number one is understanding the purpose of investing and why you are investing. Number two is having perspective around investing. And number three is how to better manage your emotions during all the market periods, like when the market is at all-time highs or temporarily down 20%. So Trent, why don't you start us off by walking through the first topic around the purpose of investing?
Sure. Well, starting at the most basic level, it's pretty intuitive to understand that you invest with a hope and expectation of earning a return on your money.
Well, that was an easy answer. Should we on to the next topic?
Hey, like many investing topics, no one said it had to be complicated. However, even though the purpose of investing is easy to understand, it's also easy to overcomplicate it because of the role our emotions play in the process. With cash at the bank, you're earning basically 0% on your money, which in reality, because of inflation and the rising cost of living each year, actually means you'll end up losing money in the long term because that $1 you have today will be worth less in the future in terms of its actual purchasing power. Because of this, the natural progression is to start by looking at what you can do with your money to earn a return on it, instead of the approximately 0% interest you receive for keeping your money in cash in the bank. This is where you look at your options of where to invest and where the overcomplication often starts to come into play. If you have $100 today, it's not uncommon for someone to ask, well, where should I invest the money? There's no shortage of opinions out there about what you should invest in, whether that's buy Tesla, invest in cryptocurrency, buy this annuity, wait until the market goes down and then buy XYZ stock, invest in real estate, etc. The list goes on and on. So how should one go about deciding which opinion is right or what's best for their situation? Well, without any context, the reality is you can't. The reason is because everyone has their own reason, unique situation, and goals for investing the money, even if they don't directly verbalize it. If Bill Gates invested $100,000 in a stock that went to zero, it won't make a difference in his day-to-day life. Whereas if another person invested $100,000 in a stock hoping to get rich quick and the stock went to zero, it could mean them losing everything they have. So going back to step one, you know you're investing because you want to earn a better return on your money than keeping it in cash. But from there, you need to understand why you're investing within the context of your situation. Are you investing for retirement 30 plus years from now? Are you investing a small amount of money just for fun? Are you investing for college costs that will be coming 10 years down the road, or maybe for a down payment you'll need in 3 years? Without knowing what you're investing for, it leaves a gray area, and this is often where mistakes occur. If you're just investing to invest, who wouldn't want to invest in the next Apple or Amazon and have 1,000 times return on your money? But you can't have just one side of the coin. You have to also be aware of what happens if things don't play out the way you anticipated or were hoping for. AKA if the stock you thought was the next Apple or Amazon is actually the next Pets.com and goes to zero instead. Risk and reward tend to be correlated, so if you invest in something with a higher potential return, the downside risk also has to be there, which, as it pertains to the stock market, means your investment could be worth less in the future than it is today. If you have a 30-year time horizon, you wouldn't care, at least in theory, that your investment was temporarily down a year from now if you knew it would be worth much more in 30 years. However, if you needed to use the money you're investing within a shorter period of time, say in 2 years, then that would be a different story. By simply having context around when you ultimately need the money and the purpose behind why you're investing, it takes away the arbitrary feeling and situation of investing just for the sake of investing. It also allows you to be more intentional with how you choose to invest your money and the risk you're comfortable taking on. When it comes to investing, things rarely work out exactly as we intend or hope they will, especially over short periods of time. But you'll be in a better position to manage your emotions if you have a plan on the front end of what you're investing for.
So you're saying the rapper 50 Cent may not have been giving sound investment advice when he said, get rich or die trying?
Well, let's just say I've heard better investment advice elsewhere.
Yeah, I didn't have to agree there. So knowing what you're investing for is an important first step, but everything is easier on the front end, and it doesn't matter your intentions if you can't stick to the plan over time. It's like someone sitting on their couch on a Sunday night eating peanut butter pretzels and watching TV, saying they'll start eating healthy and working out tomorrow to get in shape for a wedding in 3 months.
That seems oddly specific. Definitely not something you've done, right?
No, of course not. Well, maybe the peanut butter pretzels.
Yeah, that's exactly what I thought.
Yeah, so while I obviously can't relate to having intentions that I don't implement on, it can be even harder when it comes to investing because there's so much outside of your control. So step 2 of better managing your emotions is having the proper perspective and expectations around investing. This is where you need to understand when it comes to investing, risk and reward tend to be correlated. There are lots of ways to define risk, but we view it as a temporary fluctuation in the price of your investments over the near term. The more it jumps around in the near term, the riskier we view the investment. For example, the bank account balance that you'd have doesn't move on a daily basis, which is why there's no risk. Bonds move around in value a little bit more than cash, which makes the fluctuation in investment riskier by your definition. And finally, stocks have even more fluctuations than bonds, which make them even riskier than bonds. Now, the trade-off for the higher risk is the potential for a higher return. And unfortunately, you can't have one without the other. And hoping for a higher return without any risk is like asking for dessert without the calories. It just doesn't exist. And knowing the correlation or connection between risk and return can help you to have the proper expectation that your investments in stocks will move around a lot more than if you had bonds or cash. In fact, on average, the stock market experiences a peak to trough decline of almost 15% every year, a decline of 20% or more every 5 years or so, and a larger decline of 30% or more 1 out of every 10 years. However, if you zoom out the time horizon to 5 years, 10 years, or 20-year periods, the percentage odds that your investments will be worth more in the future increase up to 99% plus of the time over that 20-year time period. And the reward for taking on more risk in the near term, with larger fluctuations by investing in the stock market, gradually fade away as the investment time horizon increases. What you can take away from these statistics are that, number one, we know the stock market is going to, at least on average, have a temporary decline every year, with several larger declines throughout your lifetime. Yet, number two is, the longer the time horizon, the higher the chances your money will be worth more in the future, and the less these near-term fluctuations actually matter. To be a successful long-term investor, you have to be optimistic that in the long term, the stock market will go up. Otherwise, the headlines and temporary declines along the way may make you uneasy and result in making poor investment decisions. And outside of having proper expectations and knowing what you're investing for, the other important area to understand is how irrelevant relative performance is. Of course, you'd like to make as much money as you can off your investments, but trying to beat an arbitrary benchmark over an arbitrary time horizon often just leads to overthinking and poor investment decisions. On top of that, why does it even really matter? In the end, investing is simply a means to an end. Let's take two people who are 80 and talking to each other on a park bench about their investment returns. The first person says they had a 15% average return and had a 5% better return than the S&P 500. The second person says they had an 8% average return, or 2% worse than the S&P 500. Of course, it'd be nice to be the first person at first glance, but what if we had the caveat that the first person is expected to run out of money at age 82 and the second person has more than enough money to do anything they want? Stepping back, you want to invest money so that it is worth more in the future and can help you live the lifestyle you want on your terms. If you just focused on relative investment performance, you'd want to be the person beating the S&P 500. But if you focus on what really matters, of having enough to fund your unique retirement, you'd want to be the second person. The point isn't to accept below average returns, but rather to shift the focus of comparing to your neighbor, peers, or an arbitrary benchmark to what return you need in order to meet your unique situation, goals, and lifestyle. If you only need an 8% return to meet your goals, then is it worth wasting energy or mental headspace that you didn't get a 9% or 10% return? As you can probably tell, a big component to managing the emotions of investing is breaking down this black box and reframing how you view investing. By being optimistic about the long-term trend of investing, accepting the realities of temporary market declines along the way, and focusing on the return needed to meet your unique goals, you'll be in a better position to tune out some of the noise and stress around investing.
Yeah, we can't overstate it enough that investing doesn't have to be overly complicated, but at the same time, just because something sounds simple or easy to understand doesn't necessarily make it easy to implement year after year with that same degree of discipline and patience. So up to this point, we gave an overview from a bigger picture around why you're investing and the right perspective to have. Now we'll go through some of the common emotions that materialize based on what's happening in the stock market. As we talked about, the stock market goes up over time, but there's a lot of activity in both directions along the way. To keep things simple, I'll break down the stock market experiences into two main categories. One, investing during a market decline, so when the market is temporarily down 10%, 15%, or 20% or more. And two, investing during a period where the market is going up, say 10%, 20%, or 30% or more, from the last temporary decline. The framework is the same for both of them, which is to focus on what you can control and ignore what you can't. But there are several tangible things you can do depending on what's happening in the stock market at a particular time that can potentially help you better manage the emotions of investing. And I'll start with the first category of investing during a market decline of 10% or more. This is often the hardest period to invest or to remain invested because of human nature and how we tend to dislike losing money twice as much as we enjoy making money. It's that fight or flight mentality that kicks in, and we tend to extrapolate out into the future whatever concerns are causing the temporary stock market decline today. Having the proper perspective is a great first step. Remember, the stock market declines on average almost 15% per year from peak to trough, so situations like these are actually a very normal part of investing. However, despite how normal these temporary declines are, the speculation and fear kicks in of wondering if this is a time period where there's going to be one of those declines of 20%, 30%, or possibly even more. And unfortunately, there's no way to know ahead of time exactly when a stock market decline will end. There's no magic bell that rings at the top or bottom of a stock market move. Since no one can predict the future, this is where patience and discipline become especially important. Thinking about it like baseball, just because your team goes down 2-0 in the first inning doesn't mean they'll end up losing 18-0. Armed with the knowledge and understanding that the market eventually will hit a bottom, even if you don't know when that will be, and then resume its long-term upward trend, you just need to be able to ride out the storm. A big part of being able to ride out the storm is having enough in cash or bonds, or what we call your war chest, to ride out the stock market decline and not be forced to sell stocks when they're down to fund your lifestyle or your goals. From a practical level, it can feel uneasy to just sit there and do nothing while the value of your investments is declining, especially amidst the dire headlines you may be reading or hearing, yet that's exactly what's most important. However, there are some things within your control that you can do to take advantage of temporary market declines. The first one is rebalancing your portfolio. If the stock market is down 15%, this is an opportunity to buy stocks at relatively cheaper prices, and you can do this in one of two ways. You could invest some additional cash that may be available and sitting on the sidelines, or you could sell from investments that may be flattish or down slightly, like bonds, to buy more stocks. It's no different than going to the store and seeing an item marked down 15%, but only for a short period of time. People will often jump at the opportunity to buy things when they're on sale, except when it comes to investing. However, this is one of the best opportunities to buy more at a lower price, knowing the future price will be higher. The second thing you can do during market declines, if you have a taxable account, is tax loss harvesting. We've talked about tax loss harvesting in other episodes, so we'll keep this brief. But the idea here is that you can sell investments at a temporary loss, aka worth less than what you bought them for tax purposes. This is another area completely in your control, and it can help to improve your long-term after-tax investment return. But the biggest and often most challenging part of investing during these market declines is resisting the urge to take unnecessary action and simply staying in your seat. The second group of market movements is the periods where the stock market's doing well, think up 10% or more from the last market pullback. This is often where you see mixed emotions and differing opinions ranging from greed of not wanting to miss out on the market rise to fear about when the next decline is going to occur. Greed typically happens gradually over time, especially after strong periods for the stock market. Think about the 2000s .com boom when everyone was getting rich off of tech stocks, and even more recently with some of the big tech companies. Greed comes into play when you compare your performance to someone else or to other investments you didn't buy. So instead of being happy with your 20% returns, you might feel disappointed that you didn't have 40% returns, or that you didn't own XYZ investment that quadrupled. On the other end of the spectrum, with fear, there are always the pessimists who are looking for that next market decline or making dire predictions about what's to come in the future. And because people dislike losses more than they enjoy making money, rather than being content with the stock market going up, there are often concerns about investing at quote-unquote all-time highs or at the wrong time before the next inevitable decline. This leads to the common mistake of sitting in cash waiting for the next decline, which, similar to how there's no bell that rings at the bottom, there's also no bell that rings at the top. So by sitting in cash, you miss out on the upside, and the problems get amplified if the market continues to go up. People often end up waiting too long to invest the available money they have and miss out on the positive stock market returns. There's a great quote by the legendary investor Peter Lynch that goes, "Far more money has been lost by investors preparing for stock market corrections or trying to anticipate corrections than has been lost in corrections themselves." And stepping back, the stock market goes up more often than it goes down, and the long-term trend is up. So looking purely at the numbers and the probabilities, you're better off investing as soon as you have money available. Does it matter if you buy an investment at $40 or $45 if it's going to be worth $100 in the future? Of course, you'd rather have bought it at $40, but buying at $45 still results in a very good return. So during periods when the market is going up, there are still areas you can control and changes that you can make if necessary, but none of them have to do with trying to time the market or trying to pick the single best investment among your different options. When the market's doing well, it provides the opportunity to rebalance your investment allocation in a disciplined way. When your investments are performing well, you can sell whatever has relatively outperformed and buy more of whatever has relatively underperformed. And this allows you to complete the cycle of buying low if you rebalance during a stock market decline and selling high, rebalancing after a strong period of market performance, but without trying to time things or make any guesses. Rebalancing also allows you to keep your investment allocation on target with what's required to meet your goals and avoid any large drifts from your desired allocation. Another area you can revisit during strong periods for the stock market is your overall risk tolerance. You can reflect on your life situation, including how close you are to retirement or needing the money for your goals, and just the stresses around investing. If you had too much stock market exposure relative to your comfort level during the last market decline, the time to make a change to your investment allocation is when things are going well, as opposed to when things are going in the other direction. However, if your goals and comfort with your investment mix haven't changed, the best thing to do is stay the course and let the investments continue to work for you. As you probably noticed, there are similarities and common themes with how you should manage different market environments, but it really all comes back to patience and discipline, along with focusing on what you can control.
Yeah, hopefully we haven't disappointed anyone by not sharing a shortcut or hack of how to avoid the emotions of investing. But the reality of investing is that there's always going to be stress associated with it. When the market is doing well, you may be nervous about it going the other direction or missing out. When the market is temporarily down, you may worry about how low it could go. You can't control what the market is going to do or what unforeseen events happen in the future, but you can control how you react to these events. And if you can consistently manage your emotions, you'll be able to capture the long-term rewards of investing. There are certainly more areas around managing your emotions we could dive into, but we're proponents of focusing on getting the big areas right first before worrying about the additional details. So to give a quick recap of the main takeaways of how to better manage the emotions of investing, number one, you need to know the purpose of investing and what you are investing for. Once you have the context, you can make an intentional decision on the front end of what you're comfortable with in terms of the risk versus reward trade-off, and by doing this, you'll have a baseline to work from over time. Number two is to have the right perspective and expectations around investing. By being optimistic about the long-term trend of investing, accepting the realities of temporary market declines along the way, and focusing on the return needed to meet your unique goals, you'll be in a better position to tune out some of the noise and stress around investing. And finally, number three is about focusing on what you can control and planning around what you cannot. Regardless of what's happening in the stock market, there are opportunities available to you, like rebalancing your portfolio, taking advantage of tax loss harvesting when the market is down, or adjusting your investment allocation during periods of strong market returns. But outside of those tangible actions, the most important part is having the patience and discipline to stick to your plan consistently over time. Well, thanks everyone for joining us for another episode of the show. You want to check out the show notes, you can find them at mdwmllc.com/podcast. And as always, you're also welcome to email us at info@mdwmllc.com if you have any thoughts or questions to share. Take care, everyone. We'll look forward to talking to you again soon.
Want even more ideas, tools, and resources on how to make smart financial decisions? Check out the resources section of MD Wealth Management's website at mdwmllc.com, where you'll find additional knowledge and insight from Michigan physicians, including a blog, ebook, and one-page guides. While there, you can also schedule a 15-minute conversation with Andrew and Trent to learn more about what it means to work with the firm and how they serve physicians. If you've enjoyed the content, please leave a review on iTunes and share with your friends and colleagues. Thanks so much for listening. Andrew Mushbaugh and Trent DeBruin are certified financial planners, principals, and co-founders of MD Wealth Management, a registered investment advisory firm in the state of Michigan. All opinions shared in the show are for general information and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future returns. Please consult with your legal advisor, your tax advisor, or your financial advisor before making any decisions.